Hey, Shane.
Hey, Diana. Hope you're well.
I'm all right. It's been a pretty busy last 2 weeks with the RBA rate hike, inflation figures. Prior to that, lots of talk about if the government's adding to inflation, which we spoke about last time we were on the podcast. But I'd say the most interesting thing at the moment, is what's going on with the tech sector in the US.
Yeah, it is. It's led to a funny start to the year. Initially we start off quite nicely, and then suddenly all these concerns about AI are back hitting the headlines again. And it's not just about tech valuations. This concern that tech stocks are overvalued, there's also this concern that tech or AI will impact what are those SaaS stocks? Software as a, I had to look that up, what SaaS meant, but SaaS means software as a service company. So AI can then replicate software, which obviously, dramatically affects the business of companies that sell software.
Mm-hmm. So AI is hurting AI.
AI is hurting AI, and tech is eating itself in a way. And then there's this flow on to other sectors of the market, like real estate companies, financial companies, and so on. And so, and in fact, when you look at, I've seen a Bloomberg chart which tracks talk of AI disruption on post-earnings results phone calls. So usually when a company has an earnings result, like AMP will do this, there'll be a catch-up with analysts, and they can dial into this call, and Bloomberg's tracking the number of times that AI disruption is mentioned, and it's gone through the roof. And so investors are thinking, well, maybe this is going to be negative. AI is going to be a negative. And so US shares are actually down, or in fact, as we're talking, they're about flat year to date. The S&P 500, that's the S&P 500. If you look at NASDAQ, it's down about 3%. If you look at Magnificent Seven, which of course is those stocks like Amazon, Alphabet, Apple, and so on, they're down 7%. But the interesting thing is that you're seeing all of this going on, and you're seeing a rotation to other parts of the market.
But you said before that the concern about tech was impacting other sectors, but why is it not just exclusive to tech? Isn't it just a tech problem? Why is it flowing onto other markets?
Well, I think it's primarily concern regarding tech, because that's where the expensive valuations are. But there has been these rolling impacts on other sectors as well. But nevertheless, if you look through it, you can actually see that most other sectors are still doing reasonably well. In fact, you created that chart which looks at the equal weighted S&P 500. That's where each stock has I think it's 0.02% weight. So 500 stocks, they all get the same weight, as opposed to the standard S&P 500, which is huge weight to tech. And it's actually up something like 5.5%. So you're seeing, even though there are these concerns about disruption to the broader market, you're still seeing a rotation. So investors selling tech, buying the broader market. And likewise, you can see global shares around the world. So the US share market with a market cap weight is sort of flat, but Europe's up something like 4%. Japan's up 13%. We in Australia, we're up 3% or more.
It's not really anything new, though. I mean, these concerns about tech have been around for the last few years, basically since we've had the huge rally in tech stocks. And it's also a little bit of, it's about time that there was a bit of a rotation into other sectors, and also probably about time that the very high valuations that we have in the tech sector are softening a little bit.
Yeah, I'd see it as healthy. If you go back to last decade, I remember concerns about this. There was constantly concerns, or the FANG stocks, I think they were called. Yeah. Facebook, Amazon, I'm going to forget the name, Apple, Netflix, Google, and some of them changed their names. But, and then of course, the markets just sort of kept sailing on, with a few corrections here and there. A year ago, we had that DeepSeek correction around February last year. And then of course it was quickly forgotten about. Then we got hit by tariffs. But yeah, you're right. Valuations are fairly rich for tech stock. And so it's understandable that these concerns arise every so often. It's also inevitable that whenever any new technology comes along, that there's disruption. So you'd expect there to be more talk about it in earnings updates. So I don't really see a big surprise there.
In the near term, it probably has it could go down a bit further in terms of some further slowing in tech stocks if there's more concern and the momentum around them fades. But on a more medium-term basis, like on a 12-month view or so, given that profit growth is still pretty good in these tech companies, I mean, the profit numbers are still running at double-digit rates according to the earnings estimates.
27%.
So that's still huge compared to the broader market. There's still lots of investment into data centers. Probably argues for continued positive growth in some of these tech earnings, but obviously not at the same pace that it's been at in the last few years.
It looks like overall earnings in the US are doing pretty well. You've had, more than, I think, 78, 79% of companies beating expectations compared to a norm of about 76%. You've had earnings growth. I think it started off the season, sounds like Bridgerton when I'm saying the season, but anyway, started off 4 weeks ago running at 8%. Now it's about 12%. So again, you're seeing another stellar earnings reporting season in the US, but there's still that uncertainty there about tech. And so it wouldn't surprise me if we have another year where somewhere along the way there's a 15% correction, which is what we had last year. US was a bit more, we were a bit less in Australia. And then overall it turns out okay. And the earnings story, I think, is part of that. Looks like the Fed probably still going to cut interest rates a little bit further, and that provides support, even though other central banks are either at or close to the bottom, and there's uncertainty in Australia. And the global growth outlook still looks sort of okay. It's not fantastic, but it looks okay.
But we could be in for another year probably where the US does underperform relatively to some of the other markets like China, Europe, like it did last year in US dollar terms. Anyways, well, even in local currency terms, I think those markets outperform slightly. And in US dollar terms, Europe and China outperform the US quite significantly, or noticeably, I should say. Whereas Australia is doing a bit better this year so far.
Well, it is on the numbers, we've got up to today. It's up about 3.2%.
Why is that happening even though we've had a rate hike?
Well, I think it's happening because earnings are now rising again. We've seen...
But not across all sectors.
Not across all sectors. But if you look at the last 3 years, earnings fell. For 3 years in a row, company profits in Australia went backwards. So we then became very vulnerable to interest rate hikes or less favourable interest rate story than other countries. And so, therefore, we've had a rougher trot of it, I think. So we've been relative underperformers in local currency terms. Although, again, you had a chart which showed in US dollar terms or even Australian dollar terms, you just look at one currency. Our market actually is up on a year ago relative to the US. We've actually done better than the US. So if you adjust for the rise in the Aussie dollar, in other words, we've actually done pretty well. But I think the constraint on our market for the last 3 years was falling profits. Now we've got profits rising, not everywhere. Those companies that are disappointed have seen sharp volatility in their share price. Even companies like I saw JB Hi-Fi, fantastic profit results, and its share price fell something like 30%.
Yeah,
which seemed a bit extreme to me. But the overall picture looks like we're transiting from earnings falling to earnings rising. And the consensus, I think, in Australia is something like 12% profit growth this year. And BHP results, I was amazed that iron ore has gone from 70% of their earnings now down to less than 50%. And
I saw that this morning, yeah.
Copper is the biggest share. So huge transformation occurring at BHP. Partly it reflects stronger copper prices over that period than the iron ore price. And then, of course, banks still doing pretty well. And even if you strip out the resources stocks, mining profits are probably going to be up 30%, and strip out the banks, you strip those two sectors out, the average stock is probably seeing earnings growth up around 6-7%.
I mean, it would be good to see a positive year in Australia despite some rate hikes here and maybe the talk of another one to come, but not that that's our view, but it's still a risk, isn't it? We also had the wages data out in Australia today, actually, the day that we're recording for the December quarter.
So what do you make of them?
Well, sort of much ado about nothing, really. They were on consensus, up 0.8% over the December quarter, 3.4% over the year.
They've been that way for a while, give or take.
Yeah, they peaked at 4.2% in late 2023. So it's good that we've seen that slowing in wage numbers. But they're probably still a bit too high for the RBA's liking, and probably a little bit higher than they would have to be consistent with the 2.5% inflation goal.
So if you're a worker, you got 3.4% wages growth, and inflation, well, the headline now they say is 3.8, but for the quarter it was 3.6. So you're now going backwards again.
Yeah, a real wage decline.
So workers are getting ripped off, basically.
Well, the numbers change every single quarter. So on this quarter, real wages growth over the year has gone down by 0.2%, which basically just means that you're paying more for prices of stuff than you are in your take-home pay if you are getting that wage increase. Some of us haven't had that wage increase, so it's not like it's going to impact you specifically, but just on a national measure. But that comes after a period where we did have some real wage gains in the past 18 months or so, although there is still this gap between what inflation has done over the past 5 years and what wages have done. So wages and inflation have not caught up yet to each other. We need a period where wages growth is running above inflation to
consistently.
Yeah, that's right, over a period of 12 months or so.
You produced today, we're not going to get there till 2032. Where real wages catch up to where they were in 2020.
Well, that's what you have to assume on the forecast, I suppose, yes. But and then I suppose it just tells you that people are going to be concerned about cost of living for still a very long time from here, because obviously people are still feeling those real wage declines. And then I think it goes to the RBA's point that inflation really is the big problem in Australia. We can't have high inflation because it hurts everyone.
Yeah. I mean, I saw an interesting chart like that for the US. I don't know whether you produced it.
I did.
You did. It goes over a different period, but it looks like the wage gap that opened up over the last 5 years is now closed.
So, yes, in the US, real wages are running positively again. So we've now closed the gap between what inflation has done and what wages have done. But the US actually had higher wages growth than us, although there are different measures. So I suppose in the calculation that we're looking at, we're using a wage price index, whereas maybe we have to assume total compensation, which includes things like the super guarantee and the compositional change of the workforce. So that could be a reason for why there's a gap between the two.
But it sort of made me think, well, they've managed to do that, close the gap, but they've had similar or lower inflation, depending on how you look at it. Whereas the most recent CPI in the US was 2.5% or something, even with some add-on from tariffs. Whereas in Australia, we're 3.5% or something, depending on you look at the underlying rate around that. But the difference to me seems to be productivity. I mean, the thing that's different between Australia and the US is that they've got 2% productivity and we've got hardly anything. Our most recent period was 0.8 on an annual basis, and that seems to be the issue.
Well, that's what the RBA keeps saying as well. They do. They keep saying we only have one tool. It's a blunt tool, so it's not really up to us to sort of solve this problem or this challenge around sticky inflation in some parts, because it's down to increasing the supply capacity of the economy, which is ultimately high levels of productivity growth. But as we all know, it takes a long time to achieve that. And in the meantime, if we look at the breakdown in the wage figures today, you can see that the public sector obviously had quite a big influence to high wages growth. The areas that had the strongest wages growth was in areas related to public spending, healthcare and education, electricity, public administration. The areas that had lowest level of wages growth continues to be in the private sector. And finance and insurance, just out of interest, was the lowest again.
Not so good for us. Yeah, it just strikes me as interesting that a lot of people would look at that and say, well, if you're a worker, we're being ripped off. But to me, the issue just seems to be lack of productivity. In America, they have high productivity levels, which enables faster wages growth and keeps inflation down at the same time, whereas we just lack that.
Well, I don't think workers are being ripped off because, as you said, profit growth hasn't done anything for 3 years here. So if you look at the national wages share versus the business share of business profits, it hasn't really risen that much for businesses. Actually, if you take out mining, it's sort of gone down a little bit.
Yeah. And in fact, the turnaround sector this reporting season for the December half is mining. I mean, for a long time, mining and energy were negative. Energy is still negative. Now mining is going positive again, up 30%, whereas the rest are just doing what they were doing before. So the real turnaround has been mining. But you're right. Overall profit growth hasn't been that great in Australia.
And probably comes down to high commodity prices in recent years for mining and the energy transition as well, which is leading to higher precious metal prices.
Mm-hmm. So we've talked about technology and issues there. But there's one other point I wanted to add in. This rotation thing, which I said was positive, it is. It's healthy. It's good. But, I mean, it was at the back of my mind was what happened in 2000, where the overall US share market peaked in March of 2000 and tech starts to come down. There was actually back then a rotation into non-tech, and the average stock or the equal-weighted S&P 500 kept going up, I think, for 6 months. But the fall in tech was so great that it pulled down the overall market. So I think the rotation can be great as long as tech stocks don't come down too much. And the 2000 experience warns that could still overwhelm the whole market. Then once it starts coming down dramatically, it just pulls everything down with it, as occurred back then. Hopefully that doesn't happen. I don't see it happening, but it's obviously a risk.
And I guess you could get diversification from that by being exposed to markets that don't have as much tech in them.
Well, yeah, that's the argument, to have exposure to other share markets beyond the US. But the other thing in all of this that we haven't mentioned, but you put out a note on it today, is the Aussie dollar. We vaguely referred to it because once you allow for the Aussie dollar, the Australian share market in the last year at least has actually been doing quite well relative to the US. But it sort of strikes me that it spent a lot of time in the dog box, way below fair value, which on our estimate is around 72 cents. And then finally it's just grinding higher. A lot of those gains have been a bit more than grinding in the last few months. It's gone up quite strongly. But part of it's a falling US dollar story, and part of it's the interest rate differential story.
I think it's more the interest rate differential story, because the US dollar had fallen all through last year as well. It was down 10% continually, basically over 2025. It sort of had this initial fall and it never really recovered last year. But the key turnaround in the Aussie dollar was when the market had started pricing in rate hikes in November. And now the market's pricing in another 2 rate hikes from here in the next 12 months. And most other countries are still cutting rates. In the Western world, we're not talking about Japan here, or at least they're holding rates unchanged from here, whereas the RBA is really sort of the first one to start this this rate hiking cycle.
Hikes,
yeah. So I think it's mostly the Aussie dollar, the rate hiking story, and the lower US dollar story is part of it too, but other currencies have benefited from that too, like the euro, the yen to some extent last year, but not really so much lately. And then also higher commodity prices as well, which is just another additional factor that's been driving up the Aussie dollar.
But it's more metal rather than iron ore.
Yeah.
Iron ore.
But now, as you said, metals are becoming a much larger share of our export sector. Even gold is now one of the largest export commodities that we have, just because prices have gone up so much. And I think there's also been volume demand as well from that.
So what does this mean for the Reserve Bank? Because when I was reading their minutes, the minutes seem to be getting longer and longer. It's a bit like economists, can always keep talking, but including this one, I think. But when I read the minutes, that they actually refer to the rise in the Aussie dollar, and they say, well, if the Aussie dollar has gone up just because of higher interest rates, the market factoring in higher interest rates, then it may not be as much of a dampener on things, which I found a bit hard to understand. Rising Aussie dollar is still going to be a dampener on things.
But I suppose they have to think, well, if we don't hike rates or we don't sound hawkish, then the Aussie dollar will fall and then it won't have that dampening effect.
Yeah.
Because there's a difference between a persistent currency shock and a temporary currency shock. The RBA wrote about it in an academic paper in about 2014 when they looked at the impacts of currency movements on the economy. They looked at what changes it has on GDP growth and on inflation. And obviously the persistent currency shock has a longer term impact on inflation and GDP. There was some funny study, remember a few years ago, where they said if economists don't know the answer to something or the impact of something, they just say 0.3 percentage points. So it's like the answer to everything, like what's the impact?
I thought that was a cynical ex-colleague of ours who made that
Maybe it was. Yeah, maybe it was. I can't remember where it was an article or something.
So now I try and say 0.2 or something.
But in this RBA paper, they spoke about a 10% appreciation of the currency and the impact was 0.3 percentage points on growth and inflation. So we've had basically a 10% appreciation against the US dollar, a bit less on a trade-weighted basis, which measures a basket of different currencies. So the impact to inflation is going to be down in the next 12 months, but it's not going to significantly reduce. Yeah, basically.
But it's still a dampener on things.
On the tradables part of inflation, yes, which is about a third of the basket, and on GDP growth as well. So that's why I think maybe the Reserve Bank didn't think it would be such a persistent shock, which is why their forecast in the latest statement on monetary policy was still for higher inflation. And the only reason that they downgraded their growth forecasts was because of the factoring in of more interest rate hikes from here. So for the RBA, I still think that the inflation data is key. They'll still think that the wages data today was a bit too strong. And
because that was their 3.4 was their forecast, but they would still regard it as too strong given where productivity is.
Well, they think that the labour market is still operating beyond capacity.
Yeah.
So they'll be waiting for the employment data and the next set of inflation figures. I mean, it's hard to see a hike again at the next meeting. I think that would be overkill. And they did discuss the need for a hold in this week's minutes.
But they didn't discuss 50.
Yeah.
Like if you read the minutes, it didn't look so hawkish that they're itching to go again straight away.
Yeah.
They may go again, but
not next month.
It kind of looked like it's going to be May or something.
Yeah, so they'll assess the next quarterly inflation figures.
Yeah.
So for the time being, I think that they'll be happy to stick to on hold.
The other interesting thing I thought about in the minutes was that there's this debate as to why inflation rose and whether it's temporary or going to be persistent.
This brings me back to COVID times.
It does.
Transient.
Or transient could be the word. And the RBA assessed that, I think they said most of it could be temporary, but there was a big chunk of it which was persistent. And of course, that seems to be the debate amongst economists out there. If you think that most of it's persistent, then you're in the camp, they got to do more. If you're in the camp like we have been, that a bit more of it's temporary, and that if you look at the monthly trend, it's been down, then you'd argue, well, they don't need to do more and maybe they overreacted. And then some are saying it was all temporary and none of it's going to be persistent because when you look at, they find it hard to make this argument that there's too much demand in the economy.
There's not many of those left anymore. I think most economists are of the view that inflation's a problem. And the average forecast from economists would still be for another hike later this year.
Yeah.
But I mean, our view of most of it is transient, I think, is still intact because we've had an update to the NAB business survey, which looks at different costs across the economy, although a lot of them probably are related to the market sector rather than the non-market sector where there has been more inflation. And the PMI cost surveys too all looked more or less consistent with a 2 to 3% inflation target. So across the market sector, I think that there's clearly signs that inflation is going to, run within 2 to 3%, which is good news, but it'll be good to see some spending restraint by the government in the next budget.
Time will tell. Anyway, that's it. Thanks, Tiara.
Thanks, Shane. See you next time.
See you later.